Good evening, welcome. So Mercia is a specialist asset manager with something like 500 million in assets under management via third-party debt and equity funds, complemented by our own proprietary capital as well. And what we do is we bring all of that together with a robust regional presence, and I have a number of people here tonight from our Scottish office, for instance, in Edinburgh, our entrepreneurial insight and sector insight and investment expertise to create what we think is a sustainable, scalable, competitive advantage. Our strategy is to continue to leverage that advantage to build assets under management towards a profitable asset management business where we look to get exceptional returns from our proprietary, from our balance sheet investments. Now, our focus is the 5.6 million small to medium-sized enterprises, SMEs, across the United Kingdom. And we have three pools of assets under management, the first one being venture. And what we're looking at here is the businesses that prosper out of that 5.6 million. And to put that to context, only about 4% of those 5.6 million will ever grow to a turnover of 1 million or more, just 4%. And actually only 0.4% of those will get to a turnover of 10 million, growing at a 20% per annum rate of what we call high growth firms, scale-up firms. And that is what the venture capital community is looking for to try and source those. And we've developed a model we think works exceptionally well at doing that. But in addition, we also manage growth capital, private equity capital, and debt capital, where that's focused more at the later stage part of the cycle. And within Mercia, we have four very discrete areas of focus that we really concentrate on. So the first one is, and this is actually a stack of needles. So we don't think of a needle in a haystack. We think of trying to find a needle in a stack of needles. What we're trying to do is not only see the best deals, but ideally the deals that others do not see. And then once we've made those investments, it's to then grow the value of those investments by bringing internal resource onto those businesses. Is to continue to increase our assets under management. Put that in context, we listed on AIM December 2014. Our ticker is MERC, MERC. We had about 30 million in assets under management. And today, as I've already said, we have something like 500 million in assets under management and building. But ultimately, it's about realizing value from those investments. It's about extracting cash from the funds and extracting cash from the balance sheet investments, and I'll talk to both of those in a moment. And we do that through what we believe is our regional advantage. And it is worth spending just a couple of minutes on this. So on the very left, so this is taken from figures in 2018, just across the United Kingdom. So what you'll see, that big blue blob is London. So approximately 50% of all equity investments that took place in the United Kingdom took place solely in London. The smaller blue blobs around here, so Manchester, the northeast, the Midlands, this is Cambridge, this is Oxford. The smaller blue blobs are where the rest of the equity was deployed. Then back to those businesses, those high growth firms, the ones that everybody's trying to get hold of and capture. What I think is quite interesting is that there's only 20% of those found in London. So the easiest place, frankly, to raise money is in London if you're a young business. But actually, if you're an investor, you should be seeking outside of London for those high growth firms. You can see that those blobs now, when you compare them to the left, are disproportionately higher when you put them in the context, and this is all in proportion, you put them in the context of the capital being deployed. So what Mercia has done is it's built its operations around those areas of where those businesses are located. We have over 80 employees across 8 offices. We've got 19 university partners, and they are all located in the Midlands, the North, and in Scotland. And often what I say is if you stand in Oxford and look northwards, that's where we're hunting and that's where we're investing. Those 19 university partners account for about 20% of all the deal flow that we look and seek. Now, the investment model that we operate at Mercia uses the combination of those managed funds I talked about, as well as our proprietary capital, our balance sheet capital. The light blue there are our managed funds, our third-party managed funds. We have about 380 million pounds in managed funds. And within that, we have over 200 million pounds of free cash. So as a group, as an investment group, we are very well capitalised. Our fund management business has got enough investment. If we don't raise any more monies, if we don't grow assets under management going forward, we have enough money to invest over the next 4 to 5 years from our managed funds. On the balance sheet, that's where we look to selectively scale businesses from the managed funds. So our balance sheet capital does two things. It's a cornerstone investor in some of those funds, and it scales businesses up from those funds. We only invest in businesses that we've lived with in the funds in the first place. And just to put everything into context, last year we saw approximately 1,800 businesses, so at the very sharp end of the light blue, if you like, and we invested in about 5% of those. And then over time, that could be 6 months, it could be 6, 7, 8 years, businesses come across what we call emerging stars, and we invested in 3 of those. So just reminding you of that initial schematic we came about the 0.4%. There's about a 0.3% chance of a business from the first inquiry coming onto the balance sheet, and that's how we tackle that model of trying to find those deals that we can scale. And talking about scale, again looking at this, 2 years ago we invested £20 million as a group across the light blue and dark blue, across the funds and balance sheet. Last year that was about 44 million, and this year it will be about 60 million. We're an extremely active part of the ecosystem now. In 2018, Mercia was shown to be the 5th most active investor in venture in the United Kingdom, and by deal numbers, across the 3 asset classes I talked about, we were the 4th most active investor. So we are a very critical part of the regional ecosystem now for providing capital and support. But it is fundamentally about our ability, back to the realised value, to deliver returns. Fundamentally about that. Our oldest venture fund, 2002 vintage, it's got an IRR of 15% and has returned over 5 times the money back to investors in that fund. A number of you may be familiar with Blue Prism, business based in the regions, business based just outside of Liverpool. We were the founding and seed investor in that business. Back in 2004 was when we made our first investment in that. We invested about £900,000, and so far we've returned over 90 million back to investors for that investment, which is a phenomenal return from a regional business, which is back to my point, there's some cracking great businesses in the regions and we have access to them. But also our proprietary capital, our balance sheet is also performing well. So as I said, we listed on AIM, December 2014 we listed on AIM. So the average holding period for our assets on our balance sheet, so that dark blue piece, it's about 2.5 years, so fairly young. But actually they've been in the funds maybe 6, 7, 8 years before they come across. So that in age they're not young, even if they're young on the balance sheet. Balance sheet's performing at 15% IRR. We've made 2 full cash profitable realisations. Alinea sold to Arm, Science Warehouse sold to a PE-backed business, Advanced Company. Science Warehouse in Leeds, Alinea in Coventry. Again, really good regional businesses. Stupendous returns and full cash returns as well. Back to funds, back to balance sheet. But it's about the breadth of the portfolio going forwards. So we've got about 400 companies in our funds. Okay, so tremendous portfolio sitting within the funds. But on the balance sheet, we've got over 20 businesses sitting on the balance sheet and building. What I'm going to do for the next minute or two is just take you through, by value, the top 4. But when we come to questions, I'm happy to take any question on any of the portfolio company here and talk to that. So the first one is in digital entertainment. This is a sector that's headed up by Mike Hayes. He's the ex-CEO of Sega in the US and in Europe. And what we do is we look within sectors and we look within what we call subsectors. And we're doing this within the funds initially. So within the funds, we were looking at VR, virtual reality, and AR, augmented reality, for businesses that can occupy that space, and in particular for content-driven businesses, not for hardware, for content-driven businesses. And one business that we identified in the funds and then latterly brought across to the balance sheet, a business called nDreams. We have a material stake, and you'll notice that within our balance sheet assets, we typically hold 20 to 40% plus of the equity position in these businesses. And again, as is typical with most of our businesses on the balance sheet, they're in strong revenue growth. So in the summer, we did an RNS and we made an announcement about a multi-million-dollar contract that they secured with one of those. We're unfortunately not allowed to disclose which one, but we're one of their partners within there. We have other discussions ongoing. We expect to make announcements about further developments with nDreams in the fullness of time. Second sector is electronics, materials manufacturing and engineering, headed up by Mark Valantham. Again, a subsector within here is in premium audio. And the idea here is that cars are moving on to driverless cars, you have electric vehicles. It's all about design and audio quality now. It's about lightweighting, it's about flexible speakers. And this is what attracted us to Warwick Acoustics. Now, this is a university spin-out, and we find with the deeper tech businesses, they're typically associated with universities and university spin-outs. Here we have an electrostatic speaker that is as thick as paper. And it's completely flexible. You can cut it up, you can shape it, you can put it into the A-frame of a car door, you can put it into the ceiling part of it. It's again, flexible and lightweight, and the cost of goods are very low in that one. We've got a set of headphones. We sell headphones, and those are being sold and retailed, really showing that they can scale the production of this. This is a speaker that's made of rolls. They show they can scale the production of this, but importantly, that they can talk to the automotive industry, an industry that's typically using 12 to 20 speakers per vehicle. And what we want to do is get this technology into those vehicles and scale it through that. And those relationships are starting to build with this business. Software and the internet is our third sector. I think Alistair is here tonight, and if there's questions that you have in regard to that, I'm sure Alistair will pick those up later on. There are areas that Alistair's been focused on within sort of subsectors within this area, and bot mitigation, fraud detection and prevention is one very exciting, very high growth area indeed that we're focused on there. Again, this is a business that spent quite a few years actually within our funds before we could start to get that model right and bring it across. And what we're often doing in the funds is trying to optimize the business model so that the revenue part of it is ready to scale. Another business in very high revenue growth. And what this is doing is really looking at trying to sort of police the traffic coming onto e-commerce, onto websites, and it sits in front of that. And as this sort of quite eloquently shows, it has an AI engine sitting in there that can very, in real time, sort of categorize normal, unusual, suspicious and malicious behavior, where you've got other sites that are trying to scrape data from your site, trying to attack it, trying to bring it down and overload it. This works in real time and puts it there. This is one of their clients that has taken a license to it, and this is a SaaS model business that's growing, as I said, very, very rapidly. It's turning over about 5-6 million at the moment and growing. So what you see here is you've got something like 164,000 malicious logins coming from 1,800 different data sites from 144 countries worldwide. And in fact, these are the red. The light blues, frankly, are the ones that aren't inhabited. So pretty much being attacked from everywhere. This is one site that's been attacked from everywhere. And that blocked it. It blocked the lot. And you put this product and you give it to a client, and the client wants the product after they've seen what's going through it. It's a very attractive, very exciting business. And we often talk internally about a number of the Blue Prism, as we saw Blue Prism grow, a number of the qualities and aspects within this business as we saw within Blue Prism. And the final sector is life sciences, biosciences, headed up with Peter. Synthetic biology is an important aspect in this area and something that we're very, very interested and very keen on exploring. Myself in particular, I'm a type 1 diabetic, so I inject insulin. And because of synthetic biology, my life expectancy is just the same as anybody else's. So insulin is a biologic, and it was the first biologic brought through synthetic biology onto the market. Came in the early 80s. So for 6 months, I was injecting pig insulin, purified pig insulin, before I went on to using human insulin. And the human insulin I now inject today is better than what your bodies produce. That's how synthetic biology has impacted in this. Today, 20% of all therapeutics are biologics-based. And at the FDA, it's estimated that the products going for market authorization and regulatory authorization, about 50% of them are synthetic biology, biologic-based. So it's a huge market opportunity and a growing market. And Oxford Genetics was a business that we worked very closely with the founder, and we have built this business from ground up within the funds before we brought it across to the balance sheet. This business grew at 100% year-on-year revenue. This year, it will be 300%. This is in very fast growth. What I want to show you now is a short 15-second clip, and I'll talk through it, because they struck a very, very large multi-million-dollar deal in the summer, which we made an announcement, and it's a multi-year deal as well. And what you've got here is one room that is occupied by 2 people where they're screening daily 10,000 clones. And they're trying to pick for this client 2 or 3 clones on something that would have historically taken months and months, if not years. And they're working this on a 24/7, 7 days a week basis with 2 people. We're negotiating other contracts at the moment, and each time they secure a contract, they then operate in another room. So although this business has got 70, 80 employees now, that's in the research part of it. And what that means is that the business can now scale very, very quickly as it starts to build customers. And that is often that's the challenge that a lot of tech businesses have, is the scalability when it starts to deliver. Very exciting business. We have a material stake in that business too. Martin.
Thank you. Thanks, Mark. Good evening, everyone. As Mark's explained, what we're all about is identifying and then investing in and growing and then exiting high-growth businesses. And what I'd like to do now is just explain a little bit about ourselves, because we're also a high-growth business. So This was our first set of interim results after we'd floated in December 2014, a very young business, 7 or 8 of us, and our first set of results, half-year results, £700,000 of turnover, and the assets under management, including the 70 million that we'd raised on the IPO and the 30 or so that we started with, 104 million. And then in our interim results, which I'll talk about a little bit more in a moment, over the last 4 years, we've managed to grow that 6-monthly revenue to over 5 million, and as Mark said, our assets under management are now £500 million. So we are ourselves something that we're trying to identify and invest in. When we were last here in September talking to many of you, we were summarising our March annual results, and what we have here is our interim results to September 2018. And again, you can see the continual progress in our business. Our revenues have grown by 10%, and our cost base grew by 5%. So in fact, we drove down the difference between the two. And one of the things that differentiates Mercia from some of its comparators is our focus on what we call net expenses, minimising the difference between the cost of the investment team that goes out and seeks and develops these businesses and the revenues that we derive from our investment activities. And we had further progress in what we call our fair value movements, the growth of the value of the portfolio through fair value movements, and a fairly substantial increase in our half-year profits. And our balance sheet of 125 million net assets comprises two real key features. One is the value of the balance sheet portfolio at 77.8 million, and the cash that we had left to invest. And today we've got about 33 million left. So we are a very liquid. Not only in our funds are we very liquid, we're very liquid on our balance sheet. And in that first 6-month period, we'd invested 9.2 million. And this is the balance sheet portfolio. And many of you who've been here before will recognise that many of these names, and you can see here the progress that we're making. So in terms of that 9.2 million we invested in the first 6 months, you can see the companies there that we invested in, and the fair value movements, which is the sort of external validation of the growth in the value of those businesses. Typically, if you looked at the bottom third, so far we've probably invested between 1 and 2 million into each of those businesses. If you looked at the middle third, typically we've invested 2 to 4 million into those businesses so far. And then if you looked at the top third, we've probably invested between 5 and 7 million in each of those businesses. So our top business, Endreams, at the moment, valued at 13 million, our stake valued at 13 million. We've so far invested 7 million into that business. So the beauty of this model is that it doesn't take 10s and 20s and 30 millions of investment before you find out whether something's going to work or not. And as you can see, we look to build 20 to 40% stakes, typically in these balance sheet investments. And bearing in mind that our funds will also have stakes in these businesses because they were there first, you can see that whilst we don't control any of these businesses, we do have a good degree of influence. And some of you may have noticed our stock exchange announcement today as an RNS Reach, where we do a periodic update on each of our 4 sectors, and today's announcement was around our software in the internet sector. And you'll see there that of our companies, our software companies, they're all growing very rapidly. So where is the value in Mercia? So Mercia is, first of all, is our balance sheet, which is made up of 41.3p is our NAV per share, net asset value per share. That 125 million divided by our 303 million shares in issue gives you that 41p. And when we were here back in, I think, September, our share price was 32p? 32p, so at quite a discount to NAV. And I think today we closed at 38.5. So the share price performance in the last few months has been progressive, which is good to see. But we're still at a 9% discount today to our balance sheet. And bearing in mind that our balance sheet back in September was 39 million pounds of cash. That really does underpin our strong NAV. But what that NAV per share excludes is our profitable fund management business, which is turning over about 9 million a year and making circa 15-20% profit within Mercia. If you were to value that at, say, a 3 times revenue multiple, you'd add another 9 pence a share to your value of Mercia. And that's where we see the inherent future value of Mercia. So circa 50p per share, which, interestingly, was our float price 4 years ago. Now I'll hand back to Mark to summarise.
Thank you. Thank you. So, this is just finishing on the opening slide. And I think it's also important to note that the executive team, the board, and employees within Mercia, we have an ownership of about 23-24% of this business. So this is a business we're very passionately involved in and have an important stake in it, which does, again, differentiate us from many of our peer group. I think we do see the best deals. And that's already being delivered by the exits that we're making and the business growth that we're doing. And we see that because we have 80 people on the ground in the region seeing the deals that, frankly, the funds that in London don't get to see. So we have the privilege of accessing that. We are seeing NAV growth. We're seeing growth within the funds and we're seeing growth on the balance sheet. But the caveat being here, it's early days. They're only 2-3 years old on the balance sheet in their holding. So we think there's a lot more to come from those businesses. We are on a journey of increasing assets under management. We've taken that from 30-odd to 500 million, and our expectation and ambition is to continue to grow that. And we're already starting to see value being truly realised, so not IRRs, but cash coming back into our funds with some exceptional returns in our funds and now onto our balance sheet too. So thank you very much for your attention.
Right, thank you very much, guys. Do we have any questions in the room? We've got one here, I think.
2 questions for you. What was your best deal? What was your worst deal? And what do you think was the difference between the two? And I hate to bring this up, but down the road we've got the Brexit issue coming up. And given that you're predominantly UK based, are you viewing that in a positive light, a negative light, or neutral?
No, thank you for those questions. So on the first one, which I have been asked before by a gentleman I shan't disclose, but we compared it to being asked which of our children is favourite and why is the least favourite like that. So what I'll say is I sit on the board of Oxford Genetics, okay? So that's evidently the best business in our portfolio. And actually what makes a good deal, there are a number of things that make good, and a number of us are investors here, so a number of us will have invested in young businesses, and having a management team that will listen to you and you can work with and you can grow a business and share a vision is an absolute joy and pleasure. And that's what we're doing in the funds, and when they come onto the balance sheet, that's where they are. So I would say those balance sheet assets are absolutely there, and I'm looking at Alistair, he's on a number of our businesses, and that is a tremendous joy when you see those businesses delivering. The businesses that don't work, the ones that are the ones that they don't listen to. Because you really are trying to be, you're almost like co-founders with these businesses, especially when they're young and in the funds. And when they don't listen to you and it doesn't work, that's a real shame. I would say most businesses fail because of people, and most businesses succeed because of people. So that I'm afraid, without trying to be too flippant, that's how to answer that. The Brexit one I think is really interesting because I think we are tremendously well placed. We're a domestic fund management business. Our sole focus is in the UK. And as is now becoming very evident, we're a very important part of the UK ecosystem, providing small end private equity, debt, and venture. And we are seen very much as a solution to some of the challenges that are coming down the road, where you've got EIB, the European Investment Bank, EIF, European Investment Fund, pulling out. So when they start to pull out, who's going to occupy and carry on supporting that? And we think we're incredibly well placed. So I actually see it as a marked opportunity just because of our domestic focus and our regional strengths.
Great. Another question just there.
Do you see your company as a capital growth company or a revenue company? In other words, when you're likely to pay a dividend? And secondly, in one of your slides where you showed your position to September 2018, I noticed that you didn't have any figure in for, I think it's called deferred.
Correct. That's correct, because there is no more deferred consideration. We've fully paid for Enterprise Ventures Group, the business that we acquired in March 2016.
So that's a big, and that you're saying from now on that figure's going to disappear, has disappeared?
It's gone.
It's gone. There's no more deferred consideration.
Okay, thank you.
And we paid out the full amount because the target for that business was to raise new funds under management during the 2-year earn-out period of 80 million, and they raised the best part of 180 million.
Yeah, that was a tremendous acquisition in the north of England, and we further scaled in the north. And your other question about do you see yourself as a revenue growth and a capital? Yeah. This is why we refer to it as a specialist asset manager. So our specialism is frankly entrepreneurial strength, sector focus, tech focus, certainly within the balance sheet, and regional strength. And that's where our specialism is, and that reflects the funds that we manage. The balance sheet, you can see the assets growing. That is a capital. That is going to drive share price because that's driving NAV. Okay? But the fund management business, that offsets our costs and it will eventually move into a profitable position.
Yep.
So what we will have is a profitable fund management business, if you like, asset management business with super returns from realizations that we start to make going forwards. We have big stakes in some of these businesses. Are going, we've got 40% stakes in some of these businesses. It doesn't take much of an exit to see the return that will flow right down to the bottom. So it's what we're trying to do is uniquely position ourselves for both of those.
So if you look at total shareholder return today as a measure, then today it is all about balance sheet growth. But in the future, we'd like to see TSR including some form of yield from a profitable fund management business.
Probably an unfair question is, would you invest in SafeStay?
It's low tech.
Yeah.
Well, I suppose the answer to that is we seek to invest in things in the balance sheet that we know, we understand. And today we don't have an expert in hostels in our team, I'm afraid.
But joking aside, the beauty of the flexibility of this model is that we've got a fabulous debt team and a fabulous because you have debt. We have a fabulous private equity team and we have a fabulous venture team. Yeah. So if we've got a profitable cash generative business, our debt will come in, our PE will come in. So the honest answer is we haven't seen it. Yeah. So we'd have a look. Whether we do it or not, time will tell.
I had a quick question, unless there were any other questions in the room. No. So, do you have any sort of specific criteria, and would you consider investing something on the balance sheet that hadn't been through the funds first? And do you have a specific criteria for when something might move from the funds onto the balance sheet?
So, Martin always says to me, never say never.
Right.
So we haven't historically.
Yeah.
And the reason is that you just don't, it's an extended due diligence process in the funds. You just don't know how they're going to behave in different areas. So we haven't historically for that respect. Sorry, the second.
So do you have a sort of specific criteria for when something's mature enough maybe to move from?
So it's to do with really commercial viability. So and that invariably means the business model's been tested in anger and is starting to generate. And what we want to do with the balance sheet capital. So I've run venture businesses. So my background is I've been in a venture business. And typically you go out to market to raise money and it's 6 to 12 months to raise that money. What we're doing is we know these businesses, they're in the funds. And if they're delivering on the business model, it can be 6 weeks later. We've put scale up capital. We're usually the only provider in that. So you don't take the great management team that you put in there to build the business, to put them out on the road for 12 months to raise money. Sure. You finance them to carry on doing what they're doing. And that is a big differentiator. And that's an attractive thing for entrepreneurs coming to money for us. And it's an attractive thing for us to see businesses continue to grow, just move from the funds to the balance sheet.
Commercial traction is usually that moment. Genuine commercial traction.
Sure. Yeah. Great. Another question at the front of the room.
For the regional focus, the West, the Southwest, Wales didn't feature on the map. Is there any particular reason for this?
So Martin knows this because I've said this before. I like picking fights I can win. Okay, so we've picked regional fights that we can win and then become an important part of it. That just because we haven't yet picked the fight in the Southwest or in Wales or wherever doesn't mean we won't go there. What we're trying to do is build out from success. We're doing that. And so we will look at, I love the corridor that runs Reading, down Bristol, Bath. There's some fabulous businesses along that street, and we're already dabbling with our funds in that area, and we may well commit to that in the fullness of time.
Great. Unless there are any other questions, I think we'll leave it there. That's great. Excellent. Thanks very much, guys.